at taking predictable information and factoring it in. Therefore, only unknowable or unpredictable information changes prices going forward. So one of my toughest jobs with investors is to get them to ignore the Fed and to focus on the next 10 or 20 years. So I'm telling investors, stay globally diversified, own equities long term, and then if something bad happens with the market, you have to buy and rebalance and buy more stocks as they go down. Investors would love to get a clear crystal ball over the next 2 weeks. I don't have one.
But let's say I don't have a time horizon of 10 or 20 years, even though maybe I should. What do you tell those individuals who have a shorter time horizon? I'm not saying measured in weeks or days or months, but maybe a couple of years, but not 10 or 20.
Yeah, that's a great question. So look, every investor has to identify what risk tolerance they're willing to have. And for an investor that can't take a whole equity load, they need to have high quality short-term fixed income to offset that. So we might have clients with only 25% equity, 75% fixed income, but they have to have some equities to offset inflation, because even if you're 60 years old, you might have another 20 or 30 years left. Many investors make the terrible mistake of having far too much fixed income, and then they don't stay up with inflation. They run out of money in retirement.
Randy, you say that your investors are typically 60 years of age and over, so I feel right at home with you, my friend, but that they're interested in alternative investments like private equity. Where do you send them if that's what they want for a little juice?
Yeah, this is the approach, basically, that you want to basically have a plan for, if the economy goes into recession. We don't see it right now, and I think it would be bad if the Fed were to cut rates by, say, 50 basis points or 75 all at once. That would really indicate they see something in the U.S. economy that we don't see right now. So that would be unknown information. So we really don't want to see that, but you've got to have a plan in case something like that happens. And by a plan, I really mean you need to have some hedging mechanism in place, and you need to have some of these alternatives in place that are not as well correlated. I totally disagree with the whole global diversification thing, because the rest of the world's not doing very well. So the U.S. is the place to invest right now.
What are some of those hedges, Randy, that you're talking about that would hedge a private investment?
So we're watching a number of indicators like the S&P oscillator, or some of our own indicators like the macro VIX indicator. So we're putting on hedges in options on VIX futures in one of our funds. And then also the non-correlation is a hedge to get into non-correlated investments where, everything is somewhat correlated, but not. If you're in a private investment, it's not going to be subject to the daily repricing that the public markets are going to apply.
Mark, you like small cap stocks, small value, micro cap, as well as emerging markets. Sounds like you're out on the risk spectrum here.
Yeah, I just want to comment on our other guests' comments. Number one is most investors make the exact same mistake he just described, which is not buying things when they're low. True, global equities are down relative to the S&P over the last 10 years. That's why you should be buying them. And then the other strategies he suggested are extremely risky. It's speculating and gambling. You might as well go to Vegas. And that is not a hedge at all. They're highly volatile and have zero expected long-term return. Now, let me comment then about what your question was. You own microcaps and small values because they have anywhere from a 3 to 6% expected premium long-term. And you don't speculate with your money pretending you can reduce risk.
Randy, you get the last word.
Sure. Putting money overseas right now, essentially buying something that's cheap. It's been telling me that it's cheap for 10 years, and it remains cheap. And there's a reason that all that stuff is cheap. It's not very good. So really, I want to invest in high-quality things that are going to go up and get a good return on the investment. It's really very much common sense. You put your money where it's going to be treated well. Put your money where you're going to make a good return on it. And don't just guess that, oh, well, someday, emerging markets are going to do well.